Hello and welcome to yet another video in our series One-to-One with Fund Managers, where we hear it directly from the experts who manage your hard-earned money that you invest in mutual fund schemes. Joining us today is Mr. Dhaval Gada, Fund Manager at DSP Mutual Fund. Mr. Dhaval specializes in the banking and financial services sector and manages DSP Banking and Financial Services Fund as well as DSP Dynamic Asset Allocation Fund. With years of experience in analyzing and investing in the BFSI space, he brings deep insights into how this crucial sector shapes the Indian economy and impact investors. Viewers, for your knowledge, I would like to tell you that BFSI generally forms a considerable part of most diversified mutual funds. Today, we will be tapping into Dhaval's expertise to understand the current trends in BFSI, the role of foreign institutional investors, and what investors should keep in mind when considering this sector. Mr. Dhaval, it's our pleasure to have you with us.
Thank you so much for having me.
Yeah. So quickly, is banking.
Yeah.
Right? Banking is what? Basically a backbone of any economy.
Correct.
A few years back, when we talk about banking, the universe was restricted to banking stocks, maybe PSU and few private sectors, and maybe BFSI, very limited names. I think today it has become quite large. I think you can see banking separately and financial services separately. Private sector bank, public sector banks, NBFCs, there are also Bada, Chota, then insurance companies, mutual fund companies, depositories, stock market, right? And there may be some small IT companies which are only into catering their service. At a DSP, how exactly you are looking at this domain? Because there are two reasons why I'm asking this question. One, how an investor should approach this particular sector. To understand, for the benefit of our investors, if you tell me how DSP is looking at this segment, what is the opportunities, what is the risk, if you explain us a little bit more, sure, it will be of great help to us.
Sure. So, like you rightly said, it is a backbone of the economy.
Okay.
And especially in a developing economy, banking is quite important. Financial services is quite important part of the economy.
Okay.
It touches both economy, technology, has a vast scale, touches the masses through payments, etc. So, it is very important. And if I were to give some data, this sector today accounts for roughly 23% of total market capitalization.
23%.
23%. So when someone tells it's a sectoral or a theme, I'd say it is in itself a market, a big market, subsector.
Because we have made one more video with Chira.
Right.
So he was telling that is what, less than 5-6% of
Correct.
Nifty. That's
Correct. So this is 23% of total market capitalization. In free float, it will be even higher. In index, it will even be higher. But I'm saying total market cap value. It's
1/4 हो गया almost.
Almost 1/4 hai. Now, if you were to build a story, let me tell you a story. In 2015, this was roughly 16%.
Okay.
The same number as a percentage market cap was 16%. Banking at that point was 12%. And the balance, financial services, including non-banks, was around 4%.
4%, yeah.
Okay. Today, banking is 12%. Same number.
Same number, change नहीं हुआ है.
By and large, plus or minus 0.5% of here or there, but ज़्यादा change नहीं है. But now we are at 23%. So financial services has grown. And which is where your observation that if you look at other subsegments like insurance, non-bank, depositories, exchanges, all that capital market ecosystem, payments ecosystem, all that has come into this and taken it to 23% today.
Okay.
And so that is where the story lies for us. And this is something that we, as a trend, we observed in 2018-19. That maybe banks as a space has seen very significant part of the portfolio. It's time that we focus on non-banks and into some other sub-segments of the market, and which is where our exposure to non-banks increased. Over the last few years, capital market exposure has increased in the portfolio, and insurance has increased. So we've tried to capture some of these opportunities as part of the value creation in market. When we see developed markets, generally bank share comes down from where it is today also.
Okay.
You will find that the share of diversified financials, as they call it, which will include all other subsegments, will also see significant increase. And that is the theme that we are also in, where over a period of time the share of banks may be around these levels or may go down. but share of rest of the financial services goes up.
Pieces will go up.
Services will go up. So that's how we are thinking about it. And so when we think about exposure at banks, we think of it very rigorously. Why are we owning it? Whether this bank will command these kind of valuation, these kind of position 5, 10, 15 years down the line.
Correct.
And what are the risks when we make these assumptions? And that helps us to think both sides from a risk reward perspective.
Okay. When you are mentioning payment banks, okay, so few of them are listed recently and all those stories. Some are not making. There is no E there. There is only P as on date. So how you look that particular vertical?
Sure.
Because this presently they will be loss making or there may not be a profit there.
Sure.
So what is the future for them? Just for the benefit of the investors actually.
Sure, very valid.
Yeah.
So I was referring to more payments, not specifically payment bank, but let me help you understand what is there in payments. So you have someone who acquires customers, you have someone who issues a particular POS, point of contact, etc. EDC machines, electronic device machine that we see. So someone acquires the merchant, someone acquires the customer, someone does the reconciliation, someone helps the transaction go through.
Correct.
So there are various value chain in this ecosystem. Opportunity is huge. Volumes wise, you would have seen how much UPI has grown, credit card has grown, etc. Opportunity. But like you rightly said, money is there only in sub segments.
Correct.
Which is where the key is. Our understanding, studying global market, studying India's own market itself, is that the money is really in the payment processing business. The processing business is where the money is. So that is where our focus is. Today we don't have directly listed processes, pure play listed processes, but over a period of time we see this as an opportunity for us. We have some companies who do processing as well as issuance or acquisition of merchants. But so economics may not be as remunerative, but over a period of time, this is one area which we are. The other area which you have to focus is within issuance. For example, when I say issuance, it is issuance of wallet or debit card or credit card. Even within that, the credit card business is quite profitable on its own because it has a large economics. Interchange is quite a meaningful material in that. So there are some sub-segments within that. If you understand the nuances, the economics, the moat of each of these businesses, and if the value is right, then you can find these opportunities the way we see it.
Okay. So you have, I think when you said 23-24% of capital market all put together, number of stocks how much? Large cap, mid cap, small cap put together as on date?
More than 100 stocks that we are talking about here. The tail will be quite big, but meaningful ones are still, I would say 60-70, which are meaningful where, but let me tell you this, that this number has only grown. So over a period of time, as we see further growth, I won't be surprised if this number of 60-70 material today goes to 100 or maybe even more. So the breadth will keep happening. And then you'll have to focus more in terms of depth, where you want to allocate and versus. So the easy money was back in the 2010 to 15 or maybe earlier period was easy money was in banks.
Correct.
Today, to me, the most difficult decision is to not put money in, or how I can restrict myself to put money in banks. That is the most challenging part.
Ulta ho gaya.
So I think 2 times more when I think about putting a rupee more in banks.
Okay.
That is how my mindset works.
That is a structural change.
That is structural change.
Another 2 questions along with this. So India has reduced interest rate after what, 4-5 years, right? So repo has come down by 25 paisa. And market is quite happy, and your CPI has come, number is quite comfortable. I think from Indian point of view, there is no such major issue as far as interest rate inflation is concerned. But US has reduced the interest rate, but even after that, their future projection interest, the actual lending rate has gone up actually. The interest rate has gone up. How this is going to hit the stock? Well, first is portfolio, because we are talking especially for the NAV growth of the scheme.
Yes.
How this particular mismatch is going to put an investor in trouble in the days to come. 2-3 questions along with that. FIIs are the net buyers for a long time, but they are the net sellers now. But FIIs allocation for banking BFSI was historically extremely good.
Correct.
Now as they are the net sellers, we are seeing a kind of drought here. Whether they will come back, if they are coming back, when they will come back, a rough view may not give me the You may not be able to give the exact answer, but what is that they are looking now? Because risk-free return in US itself is around what, 5% around?
Yeah.
So they need some reason to come back. Rupee also has corrected in a pretty decent way, which is favorable to them, may not be great news for us.
Correct.
So can you package this multiple things and educate my customers?
Yeah, so on the first question around interest rate,
Yeah.
so yes, little less than 2 years is when we have now started seeing a rate cut cycle. And we've started, I would just say we've started the downward journey, whether it is 50 bips over a period of time or 75 bips or higher. I think only data tells us, and the same to the regulator probably. So that is as far as our journey is concerned. Now comes the relative world, which is US, which is a large reference for everyone globally. And they are also going through their own cycle. It's anyone's guess, when the Fed starts the next cut cycle. In the general expectation is a pause for some time, given the inflation trends there. So which will have some bit of impact in terms of how our journey on the rate cut cycle plays out. Will we be completely decoupled? May not be. But that doesn't mean that we will not have our cut cycle. So that is as far as rate. Very important nuance I want to bring to viewers' attention is that 2020 is when RBI changed the way loans were priced in the economy. For retail and small business customers, the loans were now priced on external benchmark linked, and most of these loans were repo linked loans. So when we saw the increase, the interest rate upcycle from May 22 onwards, that's when everyone's loan rates went up.
Interest rate has gone up.
So interest rate, let's say the 6.5% home loan went to 8.5.
Servicing has become expensive.
Servicing has become expensive, correct? Now we are seeing the other side of it, where everyone has now seen 25 basis points reduction on their loan.
Correct.
What does this do from a financial services perspective? The lender was earning more earlier. With his rate going up, the deposits may have gone up to that extent, but over a period of time.
Correct.
So he earned more in this process. Now it's the other side of it, where the interest rates are coming down. Maybe the deposit rates may come down with a lag. We have not seen any major cuts in deposit rate as the regulator has cut the interest rate. So that has an impact on the profitability, which is the nuance.
There is the net interest margin will come down for banks.
Exactly. So that is where the net interest income, the net interest margin will come down or get impacted. And they will have to find ways and means to navigate this.
We read that article few days back where loan growth is happening in a big way, but CASA or the FD is not growing effectively. How they can fix that issue, this mismatch?
So
it's a new world.
Yeah, so they can fix by doing more riskier lending. So basically add more risk on the balance sheet, earn more money, and therefore offset the impact. The other is fight for more CASA. So someone's loss is someone's gain. So these are the ways
competitive.
Competitive, exactly. So that is how it is likely to progress. So this is the broad impact of how the interest rates will impact. Here there are some winners, some losers. Winners will be ones who borrow from the bond market, who have seen the transmission.
Correct.
And the impact will be ones who are still in the deposit market. And this is where one of those nuances of NBFCs versus bank comes into picture. So this is as far as first part of the question. To the second part of foreign ownership, and then I'll summarize everything together.
Correct.
So if you see, and we've seen it earlier as well, it's not the first time foreign investors are taking money out and going to other parts of the world, including US.
Correct.
So this movie has happened earlier as well. Let me put the hat of our DSP, and we are partners to some for large sovereign long only investors. When we have conversation with them, and what they think today is this is an opportunity. They think of this as diversification opportunity, growth play in the world. That portfolio that they have, this is a growth play. And in that context, the correction is good news for these investors. So for one set of investors, it may not be good news in the foreign investors domain, but for some large sovereign funds, this is good news, and maybe they allocate more capital. So the limited point I want to leave viewers is
Yeah.
that over a period of time, this will course correct. If the fund look at India as a company, if the company's earnings profile, return profile, valuation profile is reasonable, attractive, some investor will find opportunity to participate in this story, and that is how over a period of time I expect foreign investors to find some equilibrium on their valuation growth and relative reference, and come back into India.
So sooner or later they will come back. Timing is the one.
Yeah, I think that something has to go horribly wrong for us to say we don't want this capital, or they choose not to put this capital.
Okay, it's a great summary. Many thanks. And a few more points. Recently, this NBFC saga, some institutions that multiple lending, multiple lot of things happened there. RBI has come very heavily on that. So can you just explain those incidents, what exactly happened, and what is the outcomes, who are all in trouble, how industry took it? Any of your schemes had any problem because of that?
Sure.
Small brief on that.
Yeah, so I mean, we see once in 4-5 years the regulator change its gear of regulation, and in the process you see some of these actions turned out to be a surprise or a shock, etc., etc.
Correct.
And this was one such instance in 23-24 where regulator changed its gear, and we saw ban as a common phenomena, relatively common phenomena compared to the past.
Okay.
And so certain entities, including banks and non-banks, get impacted where some segments, etc., got banned.
Okay.
Because they were not compliant as per regulatory standards.
Okay.
So this played out. From a change perspective, the change in governor and the new governor's commentary has brought a more restoration in the process, where it will be more consultative approach. And if they find that still the deficiencies are persisting, is when they will take this as a extreme measure. So to that extent, I would expect that in the next a few quarters or years, this being used more judiciously, less frequently,
Okay.
but being used. It is a weapon that is there to ensure that wrongdoings or deficiencies are not permanent. So that is how I perceive, as an investor, I perceive it. In terms of portfolio impact, yes, we did have one direct hit, which was IIFL Finance, which was part of the Banking and Financial Services Fund, part of several schemes at DSP, which was impacted, where roughly a third of their portfolio, which was the gold finance business, where the ban was put in.
Impacted.
And so they had a loss for a couple of quarters in terms of earning, and they are now coming back. And so yes, so to that extent, we did see one impact. So and then we've come out of
It's a
it.
part of life. Yeah.
Yeah.
We have to do that.
This is learning.
Correct.
Expensive, but learning.
Learning, yeah. And one more question around same topic. Say we are mutual fund distributors. We generally recommend broader market products like multi-cap, flexi-cap, large and mid-cap, maybe a small portion to value, then small percentage to mid and small cap to balance the portfolio. In general, we don't touch sectorial fund to the retail customers because SIP, many of our customers are SIP customers. It may put them in trouble. But when you are telling me banking is around 23-24% of the index, is it really makes sense to put some money to banking sector? If yes, SIP makes sense, or can he put bulk money in a scenario like today? Or is it should be a pure tactical call? He should plan his entry exits. So can you just give this more information which will help the investors?
So general rule, there are normally general rule, and then there is an exception to the rule. So in this case, the way I always advise clients, investors, is that this should be an exception given the size of the portfolio in terms of what it is trying to address.
Size of the industry.
In the industry, the underlying industry, the opportunity is quite immense compared to any other themes or sub-themes, so to speak. So that is one important dimension to consider. The other part is look at the benchmark for the banking and financial services one. The Nifty Financial Services TRI is the benchmark. That benchmark on a 10-year rolling basis has 100% of time beaten Nifty. More than 80% time, it has given double-digit percentage return on a rolling basis. Historically, 7 and 10-year rolling returns are double-digit 80% of the time, more than 80% of the time.
Correct.
So what that tells you is two parts. One, there is something in this theme which is more than a theme. And the other part is that timing wise, if you're there for the long term, it relatively matters less because you tend to get more return at the end of the tenure. So those are the two dimensions, and which is where I would say that if someone is thinking about it, SIP, yes, great. For long period, then fantastic. If someone is thinking about lump sum, then my submission would be that you should stagger it over the next 6 months, given what's happening in the operating environment.
Yeah.
Because from valuation perspective, banking and financial services index would be amongst the few in the market today, which is significantly below long-term average multiples. So your entry valuation is not quite expensive.
Okay.
And so if return ratios are in double digit, you will without any multiple expansion, you will earn that kind of return, and with some normalization back to long-term average, you can earn slightly better. And as active manager, alpha will be on top of it in terms of outcome. So that is how I roughly summarize that if you're lump sum, stagger it over the next 6 months. But if you're a SIP, very disciplined, systematic investor, then long period SIPs will turn out to be a very good outcome.
Very good idea. So your point here is you can still consider this as a sector, even though it's a sector, but it's quite vast.
Yeah.
And you also mentioned that number of opportunities around 100 plus, and this number is going to go up. As a sectoral allocation, if you want to do your financial planning, goal planning properly and allocate some money.
Yes.
And presently, as FIIs are the net sellers, there is a reasonable more quantum of outflow from this segment.
Yes.
So this particular segment is much cheaper when compared to the benchmark, the broader benchmark, maybe Nifty 50 or Nifty 500.
Correct.
This is the conclusion?
Correct. One last point, if I were to add, if you look at the recent fall, and I know it's a very short time that we are looking at.
5-6 months.
5-6 months. But from peak to now, this sector has fallen relatively less compared to the broader market as well.
Okay.
It has fallen, the index has fallen roughly 8% versus the benchmark would have been double-digit fall from the peak.
Yeah, but bigger fall has happened previously here.
Yeah. So, which is what I am saying, that valuations are in your favor. So, somewhere that point of valuation, which was true last year, the year before that, is playing its part, especially in the down market with falling less, where in an up market, my view is that catalyst will come to give you that outcomes that I...
surplus,
yes,
whatever it has.
So you're not overpaying, which is a very important point.
You are not overpaying. Yeah, that is a very important point. Yeah. Last, just to sum up, what is your experience? I think you are, 15 years?
Yeah, more than 15.
More than 15 years. What is that you are trying to tell for our viewers as from banking and financial sector? Because that is one of the most happening segment. So what is your experience summary, how investors should look at market, how investors should look at mutual funds? Some brief.
Sure. So my only submission is that don't ignore this space because it's a very important part of the economic journey that we are in. So ignoring will mean that you have one less wealth creating opportunity. So keep a focus on this opportunity and look for areas where it is more outside of banks rather than just focused on banks. And one common point that I get at least asked from viewers and investors is that we have diversified funds and banking and financial services is a large allocation. So I always tell them that if you were to dive deep, bulk of that exposure is in banks.
True.
And I am saying that you focus away from banks because that is where the delta is visible as per data. So
yeah,
don't miss the opportunity.
Don't miss the opportunity. Mr. Dhaval, thanks for giving us your quality time, and you have given us decent, valuable insights for us. On behalf of all our investors from ARA Financial Services, we are really thankful to you.
Thank you.
Thanks for your time.
Thank you so much. Thank you.
Viewers, we are quite confident that these kind of conversations are quite useful for you to understand how fund managers think. These videos also help you to take right decisions on your way towards your financial independence. Do subscribe to our channel, If you found these conversations are quite useful, don't hesitate to like us, share these contents with your friends, colleagues and dear ones. Do follow us for more episodes of One to One with the Fund Manager. See you next time.